So talking with Brad Raw about SMSFs and specifically just contributions into super. There's different types, and our clients often get a little bit confused. We talk language like concessional or non-concessional, and whether it's taxed or not taxed. What I put in, what I take out. Brad, are you able to summarise just in layman's terms for clients to understand, with what money they put into super, what are they? How they tax when they go in, what are the benefits maybe, by contributing to super, to a tax deduction in a personal name, and also when you take the money out. Can you just explain a few things there so people can be a bit more clear on that?
So look, from the terms you'll normally see, concessional contributions are your pre-tax contributions. So they're your employer contributions where the employer is paying money into super, where it'll attract a 15% tax inside super, as well as maybe the contributions that you may make where you may be claiming a tax deduction against your personal income. So there are rules where if you've got member balances below $500,000, you can catch up that 5-year period. So this is a common strategy that we're starting to see a lot of clients do leading into retirement, or they've had a significant windfall in an estate or in a sale of an asset. They may contribute 3 or 4 years in a row, so they might be able to claim a tax deduction for like $100,000 into super. So they're those pre-tax where you're getting a tax benefit of putting that money into super. Those non-concessional or the after-tax contributions, there's no tax benefit for putting that money into super, which also then means that when you withdraw that amount out of super, if you're an adult beneficiary that is not, i.e. not a spouse or a non-financial dependent child, they won't have to pay tax on the money that comes out that's in that tax-free portion. So that's the main difference between the concessional contributions and the non-concessional contributions. And then when when the concessional go in, they're called taxable, which will then attract a 15% plus Medicare when the money's withdrawn, but they're also getting a tax benefit on the way in. Those after tax, there's no benefit on the way in, but they're getting a benefit on the way out.
And on the tax benefit side, at an individual level, that really depends on what their marginal rate of tax.
Yeah, so if you've got income above the Div 293 threshold, which is $200,000, where you've got your super contributions plus your personal income is above that $200,000 threshold, you actually have your 15% tax that everyone pays, but then you'll have an additional 15% tax on those contributions. But that threshold of 200, you're going to be on the top marginal tax rate of 47 cents plus Medicare. So they've just created that process. So someone that's earning, say, 150,000, they might be on the 32 cents. They're both getting similar tax savings around that 10 to 20%.
Just for the benefit of listeners, Div 293, because we chuck this around, essentially you pay 15% contributions tax when you put money in, but if your adjusted income is over a certain threshold, you pay up to an additional 15 cents tax on top of that. So just, always talk to us about putting your contributions in before June 30 every year. So concessional. I suppose another way, also looking at this definition of concessional versus non-concessional. Concessional also means I get a tax concession on that, a tax benefit. So that's another way of looking at it as well. So, okay, that's a little bit clearer, I hope, for some people.